Hi, this is Mark Carrington. This video is a review of the use of Bollinger Bands and momentum indicators for deciding when to exit a trade. And the question has come for a trade that was entered last week, so late October 2014, on the S&P 500 index. And the trade was entered using Bollinger Bands. So we have here the chart of the S&P 500 index, and it was entered using the MACD indicator when the blue line, the signal line, crossed the orange line. So we have a trade entry at this point. So somewhere at this level here, at the 1900 level. And the question is that how do we use MACD and Bollinger Bands to decide when to exit this trade? And as we've seen, the trade has raced up and is now testing the September highs, but has not yet reached the Bollinger Band. So what I'm going to do in this video is I'm going to go back in time to look for a similar trade situation and track through what actually happened. So what I'm going to do is I'm going to squeeze up this chart until I see a MACD situation similar to this, so something that has been oversold and then has turned up. So I'm going to keep going back in time until I see one that is similar, and then I'll have to squeeze the price chart so I can actually see. Because in the process of doing that, I will also be identifying what we're actually trying to capture from the trade. So I have one there that is reasonably oversold. And there is another one there, although this one's a bit tricky because it actually crossed twice. So let's keep going back in time, and then we have one here. Here's one sitting that looks pretty interesting. Is that we have an oversold position here, and we've got a signal, and we're going to run. Now the challenge we really have is that the best of them, or maybe we'll have one that's even stronger than that. I'm a bit uncomfortable with that one because it's looped down twice. And maybe we've got one here. Let's look at this one here. This one here is the end of the GFC, so that's probably never a good example. And there's one here, and there's one here, and there's one here. Let's pick this one. I'm going to pick this one here because we've got a bit of sideways stuff going on here, and so we're going to pick this one here. So we've got an entry point here. So I'm going to zoom into that time frame. If I can actually do it this way. Okay, this is the one I'm going to use. So what we see here is we see an oversold situation. We've got our signal, and we've got a price that is raced up towards the Bollinger Bands. Now, is that the best one though? I don't think it is, because we haven't really tested that Bollinger Band. The one I had earlier was better. That's the one here. This is the one I'm going to use. Because what I want to do is I want to find one where I've got an oversold situation, and then I'm going to and it's raced up towards the Bollinger Band. So the challenge for us is to decide at what point we want to. I'm going to leave the price history in here because what we want trying to do is we want to see, well, how much of this up run can we actually capture. So we're going to put in here two two horizontal lines. We've got a horizontal line which is our original stop loss, and I'm going to put a horizontal line for our entry point. So our entry point was after the crossover, so the entry point is here. So the first principle of using Bollinger Bands is that while price is tracking up and not touching the Bollinger Band, we do not want to do anything. So we're just going to wait. And so we can see here that we've gone up here, we've touched the Bollinger Band, but it's only a touch, and the next bar after that makes a higher low and a higher high. So we're not interested. We're just going to keep tracking until it next touches the Bollinger Band. So we go up top here, we've got the next touch of the Bollinger Band, the next bar after that, it makes a lower high but a higher low. So we're actually not interested in that. The market is showing indecision. The bar after that is showing indecision. If we go along then to the next touch, the bar after makes a higher low and a higher high, so the market is actually interested in heading upwards. This next one along here, the next touch, is actually price goes outside the Bollinger Band. This is when we're starting to get interested, although we have a close inside the band. So the question is would we exit at that point? Well, if we look forward, we don't really want to exit that. So how do we know that? We know that because the MACD is still strongly positive. The signal line is above the orange line, and it is strongly positive. So that one there, we're going to ignore that signal and continue moving. We don't have any touches in the Bollinger Band. We're above the mid-range. We get a touch of the Bollinger Band over here, and that's the first point at which we have the signal line has now crossed below the orange line. Do we really want to exit there? And how are we going to choose? What I would typically choose is that because I'm above the middle point of the Bollinger Bands, I'm going to stay in the trade. And I have a touch here, and I'm still negative, but this signal line is below, but I'm still above the midpoint of the Bollinger Band, so I'm going to stay in the trade. We're going to head up here, and at this point here, we've got a bar that has closed entirely outside, so the whole bar is outside the Bollinger Band. Now this is a strong sign of a potential reversal. The question is should we exit at that point? And the answer, the MACD is not helping us. Yes, it is in an overbought situation, but the signal line is above the orange line. So you might be tempted to want to stay in the trade because it may just track along sideways like that and then keep running. But it is also a strong signal to move a stop loss, but I'll come back to dealing with stop losses, because we can choose to say, well, if our trading rule is that as long as we are above the midline, we will stay in the trade. So we're above the midline all the way through here, and we actually go below the midline and close below the midline, but do not touch the Bollinger Band at the bottom. So could we envisage staying in the trade here? Well, as it happens is because the MACD is still above the zero line here, there are grounds for staying in the trade, because above the zero line means that this trade is still bullish. And as it transpires, we have no touches on the lower band of the Bollinger Band. We could actually argue that we could stay in the trade and then continue running. And then at what point would we be looking to exit this trade? Because what we've said is our rule is going to be is as long as MACD, as long as price is above the mid-range, we will stay in the trade. So we have to decide what we're going to do here. We've got a close below the middle of the range, but our MACD is still strongly positive, so we can choose to stay in the trade. As we run all the way up here, we have a close outside here, but we're still strongly positive. We have no turn signal. We do get a turn signal here on the MACD, but we have not touched the Bollinger Band. So our rule is, if we've not touched the Bollinger Band, we're going to stay in the trade. We now have a situation we've crossed below Bollinger. The MACD is still positive. As we're tracking along here, we now get a crossover. We get two things happening at the same time. We've got our signal line has crossed the zero line, and we have a touch of the Bollinger Band, and that could well be argued for being a good time to exit the trade. So we exit the trade there. So if I go back, that is how much of the trade we have captured by applying those rules. And the challenge, though, is to say, well, what have we left on the table? Have we left stuff on the table? And as it transpires, on that particular run, that looked like a good point to exit. Now, could we have improved that that trading plan? I will make that as the subject of the next video, because now in this particular run, how much more improvement we could have got is we could well have got out up here. We could well have got out up here because we hadn't really got to the high. Now the challenge is how could we actually get to that point? Or we could well have exited over here, and could we have reached that point? Of course, the compelling thing here is that there's another buying signal here, there's another buying signal here, so once we're out, we don't have to worry too much, because there's always a chance to get back in. But I'll use the next video to go through a slightly different strategy. I hope that helps. Thanks.